Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry market analysis and trade ideas webinar, as well as an Asian scalping session. It is currently roughly 8:10 p.m. Eastern, Tuesday, August 15th, just going into Japan market opens here. Now, we're going to be continuing from our previous market analysis and trade ideas webinar, where we do have trades playing out across the board. We just want to look at what economic events we have in focus first through the Asian session, London and New York tomorrow, and then do our individual analysis on the pairs as well as trade ideas, and then transition into an Asian scalping session here. I had some power outage issues earlier this morning, so we weren't able to do the New York session, but we aim to do it at least 4 to 5 times a week out of the 5 trading days. Usually one day is just in case I have other responsibilities and things going on, or also with how market conditions have changed, it's also good to pick a day here and there where from a scalping perspective, you just stay out of the markets, especially when you can anticipate a lack of volume and volatility. But today wasn't that case of volume and volatility. I just had a power outage issue. It didn't come back until later in the afternoon of like the North American trading session. And of course, that's why I still wanted to do this Asian session. And then we'll do an extended New York session tomorrow morning. Wednesday, depending on where you are, obviously, in the world right now. Okay, so in terms of economic data, just through the Asian session, we have some NZD interest rate decision from the Reserve Bank of New Zealand, of course. Now, they're just expected to keep rates unchanged and remain in a restrictive stance around 5.5%. We don't really look at any NZD pairs, but as it's in focus through the Asian session hours, if you were to get any surprise changes, like a rate hike or something like that, it can obviously impact other asset classes as you'll have a shift in market sentiment depending on the result. So far, it's expected to be a relatively copy and paste statement, keeping rates unchanged, which is the highest probability there. Then we have some economic data through the London and Euro session, which first set is looking at UK inflation figures, looking at your CPI figures, producer price index, and so forth. Now, obviously, as the Bank of England has been actively raising rates and raising rates in the most aggressive fashion that they've seen in their history, you're going to see that trickle down effect and starting to correct a lot of the inflation that was caused by massive stimulus. So it's pretty well expected that we're going to be seeing some declines in UK inflation, and short term, if we're lower than the forecast here, because this is quite a large ask on CPI headline year over year, but it is expected. It's pretty well known when we've been breaking down the base effect and talking about the US inflation examples. It's the same exact foundational understanding to knowing what's going on with the UK inflation scene. They're just a little bit behind the curve compared to the Fed. So as the Fed has already passed the base effect there and has already corrected the inflation caused by massive stimulus and are now seeing troubles in fluctuating inflation reports back to baseline around 3%, UK is still going through that phase of correcting the stimulus inflation, still going through the base effect there. So hitting 6.8% is a pretty reasonable target, even though it seems large. Now, if we want to see weakness in the British pound and signs that the Bank of England can take a slower and steadier approach and be less aggressive with any further rate hike decisions, these inflation figures are going to need to come out lower than the forecast. Because of the reasons stated, it's already expected that UK inflation is going to be declining, right? the massive amounts of tightening that's occurred, the base effect, correcting the inflation that was caused by stimulus, active trend down in inflation. It's already expected on CPI, yearly, monthly, producer price index data, and so forth here, right? So if we actually want to have any GBP weakness, which on GU would extend some of the dollar strength against the British pound, but on GJ would lead to a data-induced pullback short term, the inflation figures are going to have to come out lower than forecast. If we're higher than forecast, this can actually still keep some demand in the British pound, as it shows the Bank of England needs to stick to their guns of keeping rates up higher for longer, even possibly having the Bank of England, the rate futures market for the UK pricing in more rate hikes to come, right? I personally think that we can be, for the example of CPI year over year, that we can be around forecast or lower. We still have the base effect in play. We're just correcting the stimulus caused inflation from the pandemic. And it's a pretty similar pattern that we saw take place with US inflation. That the Bank of England and the UK just a little bit behind the curve. So it's almost like the scene and what has gone on with US inflation is pretty much showing you the path that UK inflation will follow, where we won't really see troubles in inflation data, one, unless there's some major global fundamental reason for it, or two, until we go back into the sticky zone of reaching inflation figures back to like 3%. So I'll show you that example here when we look at the chart. Right, and then we'll look at US inflation side by side. And you'll see what I'm talking about how because the Feds were the first central bank to get ahead of the curve there on their rate hike cycle and front-loading rate hikes and combating inflation, we saw a much more consistent decline in US inflation figures back to baseline, right? So keep in mind, both of these countries, both of their countries' respected central banks, they have the exact same inflation goals. They want to bring inflation back down to 2% and not just hit 2%, keep it there for an extended period of time, right? So same idea. This is the goal point, 2%, 2%. You can see around 3% is entering the sticky zone we were talking about, where it's going to take more than monetary policy to bring inflation down to there, right? Because you're going to have sacrifices in the economy and so forth. This was the massive increase in inflation caused by stimulus. And you can see these reaction points of where you had some fluctuations in the reports for a month change or 2 month change before still extending higher. And then this was the base effect of equal or more aggressive tightening that occurred by the central bank on the flip side in 2022, where you can see you corrected that inflation all the way back down before seeing troubles in the sticky zone again, right? So UK, they followed the same path of dropping interest rates during the pandemic, of increasing money supply, pumping their markets, keeping financial conditions very loose and so forth. And they had that surge in inflation here, right? And you can see the reaction points where you had some minor fluctuations before extending higher. Now, as we've been making our way down with the base effect there, correcting the stimulus-induced inflation, you can see we've pretty much just had similar reactions, but until then, it looks like we are going to be correcting back down into like 6%, 6.5 to 7% here, where this was a little bit of a minor fluctuation here, right? So because of understanding how inflation moved during the stimulus phase, and then the equal or more aggressive correction that occurred during the tightening phase, you can see where those forecasts come from. This last fluctuation point when inflation was rising during the pandemic period, you can see that's pretty much where the next guesstimated forecast is for inflation to drop. CPI year over year to drop from 7.9 all the way to 6.8. I think we can easily do that still, right? I don't think the UK is going to really start to see inflation troubles until we maybe dig into 4.5 to the 5% range. Even then, like 4 to 5% range here. So if CPI does come out right on forecast or a little bit lower, even going to like 6.5%, 6.6%, then it can lead to some intraday British pound weakness. And it does look like CPI is going to come out right on forecast or a little bit lower. We've already had that fluctuation on equal sides here when we were at around 8.8 to 9%. Then we're expecting a pretty clean free fall into this next area of fluctuation, which is around the forecast of 6.8 to 7%, but there wasn't major fluctuation there. So we could easily drop a little bit lower, might not see a bit of contention again until reports are going near 5.5%, and then really into the sticky zone, very similar to the US inflation path. Okay, something to look out for, obviously, as that's important data through the London session and for GBP pairs and market sentiment. The only thing is it's already expected inflation is going to be dropping for the reason stated. So to hold more market weight, aka bring more volume and have some more impact, we're going to have to come out a little bit lower than this forecast. Come out at like 6.5, 6.5 to 6.6. Any lower, the better in terms of bringing some short-term GBP weakness. And if we're seeing fluctuations a bit above this area here and coming out short at like 7.1, that's still going to lead to GBP strength. I personally think this number can come out around 6.7 to 6.6 in my opinion and be lower this time. We might not see fluctuations in UK CPI until there's either more economic decline or economic uncertainty, or until we're hitting back into historical sticky zone levels, which in the UK here is looking like we were talking about from like 3.5 to 5%. Other than that, also then for Euro pairs, at 5 a.m. Eastern, Asian session close and the 4-hour candles for most brokers. We have some GDP figures quarterly and yearly, flash estimate towards the actual, which will be like a month or two later, but still important data. The flash and actual usually don't see major fluctuations. So like if we open this up here, it should be more of like a bar chart, and then it'll show like it loads here. So here you go. So this is how it gets released is you have your preliminary data and then your flash estimate actual data. I didn't mean to change it out of the bar chart there. I want to put it back, but I don't know what button I just accidentally clicked. But maybe if I refresh it. But you can see for the most part, they're very much in line. So that's why the data reports are important. It's very rarely you see any major fluctuations between the estimate, preliminary, and the final there. So with the Eurozone, we have, of course, been seeing some contractions in the Euro economy, feeling the heat with geopolitical tensions, the energy crisis that's going on in the Eurozone, of course. Then, of course, you have a higher interest rate environment, while Euro inflation figures are still following closer suit to the UK. We're still at elevated numbers, right? US is ahead of the curve where they're back down to baseline and still, of course, facing the real fight, which is keeping inflation down to the 2% goals, which is going to take sacrifice in the economy. You have to understand ECB was a bit behind the curve, and they were raising rates from negative interest rate territory into positive. So they weren't just moving like the Feds or Bank of England or Bank of Canada going from 0% up. They're coming from the negative interest rate territory, then going into positive integers there, right? So there's expectations that we can see contractions in the Euro economy, weaker data. We've seen more banking sector uncertainty in the Eurozone as well, with a larger institution, and overall Eurozone's in shambles. Pretty shit economy over there. So I can see this data potentially edging a little bit to the downside here, or just being right on forecast. Industrial production is already painting a more clear image where the forecasts are already skewed to be more negative. The only thing is, if we want to hold weight and bring more negative sentiment to euro, we're going to have to be worse than forecast, which is very much possible. This can easily come out at like a minus 0.3% for industrial production monthly. Industrial production yearly can easily come out at a minus 4.4, 4.3%, and so forth. Then, through our North American trading session, relatively quiet. Just some housing numbers at 8:30, which isn't going to hold too much weight. The data that is in focus is some industrial production, which is expected to show some slight signs of rebounding. But we've seen the recent Fed manufacturing business survey show a drastic decline. We're starting to get signs of cooling with factory orders and durable goods. PMI figures are starting to edge toward the downside as well. We may not meet this forecast. We may come out at like a 0.1% or minus 0.1, showing some slight rebounding from prior, but worse than forecast still. If that's the case, that's going to lead to short-term dollar weakness, more demand still being held in gold. The opposite, if my prediction is wrong and industrial production is still resilient and we're exceeding the forecast here, showing continued signs of optimistic data in the US economy from the industrial sector there. Other than that, nothing else really going on through the North American trading session. In terms of a central banking and political events, tomorrow's the 16th. We do have FOMC meeting minutes. So that's at 2 p.m. Eastern in the afternoon. If there's any revisions in there about forward guidance on the rate hike path with updates that we've seen with inflation expectations elevating slightly as we enter the sticky zone, that can bring some market weight. I personally am not expecting any revisions or changes. I think it's still going to be a copy and paste FOMC with the main FOMC meeting minutes with the main focus on the next FOMC to come. Nothing really going on from a central banking perspective here. We do have an APEC energy ministers meeting, which can obviously be impacting commodities a little bit, mainly looking at like crude and stuff like that. Nothing else really going on. Now, when we're looking at gold here, for example, as we've been overall playing this bearish run below the 1980s, this was primarily induced based on an understanding of fundamental important prices. We knew that if we didn't have any new fear, uncertainty, or doubt, that if we didn't have any consistent bad economic data, where at that time we were still remaining relatively resilient, and if we didn't have any fundamental catalyst that's equal or if not holding more weight than the COVID lockdowns or Russia invading Ukraine or banking sector fails, then my expectations of gold trading to the 2000s or holding above the 2000s really starts to diminish, right? So it was a fantastic bearish run that we've been playing level to level as we've been continuing to monitor economic data and so forth. But now we have to be very, very careful as we have been approaching this next major intraday liquidity zone of interest here, which is roughly at the 1895s to 1905s area. It's quite a large area in general, where we've seen some large rejections and buy moves, even retests into this area again, and buyers still extending higher here, right? Now, today, with some of the Fed business manufacturing survey report we had and retail sales, the data results were mixed. The business survey on the manufacturing side was completely, utterly dog shit. Well past maximum expectations, deep recession scare territory data. But the one thing you have to understand with this data is it's very common to see those aggressive fluctuations. So it was very bad data, but it's not something that's solely alarming in its own. Retail sales was still showing signs of resilience, but that's not because we have a healthy US consumer. It's because that credit card debt has still been exponentially rising as the US surpasses 1 trillion in credit card debt. And of course, we've seen inflation trickle back down to that 3% level, which obviously is going to ease prices when you're just looking at your general basket and cost of goods, right? So that alongside increases in credit card activity, more people incurring debt is still going to keep retail sales relatively elevated. The fact that we're not seeing any optimistic surges in retail sales, that's a key factor. So as we're starting to get signs of the labor market cooling, where we just had our real first signal and sign last week with that jobless claims report going above the surprise maximum expectations of 240K, something that we've been highlighting and talking about, right? As we start to get signs of the labor market cooling, the delinquency rates on credit card debt rising, still seeing rates up higher for longer. And we're also seeing with what I sent in the trade room, the data dumps recently, the same time credit card debt is rising and the labor market starting to cool, personal savings of the individual and consumer / worker within the US has been completely diminished and is like the opposite, right? Let me see if I can find that chart again quick. If somewhere here in the trade room, but I can't find it right now and I don't want to waste too much time. It's all good. So basically, you can just go through the trade room when you have some time, but it was a chart highlighting and comparing personal savings versus credit card debt. And they're going in opposite directions, right? Personal savings is going straight down and credit card debt's going straight up, right? So as we get those signs, we're going to start to see weakening in consumer confidence again and consumer activity. We're starting to see signs of contracting data with the manufacturing report we had, obviously, today, with that jobless claims, even with some of the uncertainty developing on a global scale with China's dark economic data that's been coming out, negative economic data, right? So we're starting to get potential signs of the tides changing and a little bit more fear developing regarding global economic health, future GDP projections, the soft landing narrative starting to get shaken out. The same time, gold is approaching this important buyer demand zone roughly into the 1900s. We'll just say the rough 1900s here instead of just having to say that huge range again, right? So into the 1900s here. Now, what's very common with gold and why we do not need to rush, we can take our jabs, right? Like, for example, I took a buy limit trade at 1897 and a 1902 buy as well. I closed the 1902 buy, took my profit off the table there, partially closed 1897, leaving that one running risk-free. If that position gets taken out and gold does something like this, I'm not going to freak out or be mad. I'm just going to stick to my same analysis and take another position. Taking these jabs before I can hold a knockout punch. So what do I mean by that? Well, when you look at gold, whether you're bullish or bearish, whenever you're retesting important liquidity zones, it's very rare that you're going to retest that liquidity zone one time and start to have major intraday movement. Yes, it happens, but it's very rare. What you should more depend on and have increased expectations for is that you can be retesting a price sensitivity area multiple times before continuing trend, right? So let's look at this bullish run that we've had from 2023 onward, even more importantly, with the fundamental catalyst of banking sector failures, right? Let's really zoom in more and look at this. And you have to think in the perspective of manual execution, what's probable, and not like thinking in terms of a hero of like trying to catch a wick, but thinking in terms of increase of what gives you the most increase of probability of putting odds in your favor for executing a trade on gold, right? And for me, it's from a day trading perspective anyways, even for scalping, it's really focusing on major higher time frame liquidity zones or intraday liquidity zones. If you can just wait for trades on the intraday at higher time frame key levels or important liquidity zones you can identify on the intraday time frames, and you don't trade any other time, I don't want to make promises. It's very difficult to be losing long term. Keyword losing long term. You're 100% going to incur trading losses. But as long as you're sticking to these rules of playing these major liquidity zones, patiently waiting for trades off of there, sticking to your risk versus reward, taking some profit off the table or securing positions, with those inevitable losses, you're still going to be net gains overall. And this isn't just talking after the fact now. These are trades that have been called out in Capital Hungry, and I myself have taken hundreds and hundreds of times. But anyways, what I want to talk about here is whenever you have gold trending bullish or bearish, in this example, trending a lot more bullish as we have Fed pivot rumors fueling the market with a dollar weakness at that time, more stock market greed, more greed in majority asset classes, then banking sector fears, which brings even more demand into gold as a safe haven asset class, right? You can see it might not seem like much here. You might just see a double bottom, right? You just see a double bottom here. I see gold retesting a liquidity zone for more than 30, 40 hours. That's how you have to look at it and be like, okay, gold retested this area over a period of 30, 40 hours, still failing to break lower before extending this move to the upside. Then even had an aggressive pullback phase into that same liquidity zone, still rejected for another 2 days before extending higher. Why should you think this way? Because whenever you're looking at gold approaching a major liquidity zone, like we're looking at gold at the 1900s, this prevents you from taking some impulsive, stupid entry on one singular tap on the 1 minute time frame where gold can dig a little bit lower, snap back above, reject, come back low again, do something like this, dig back into the zone before really having the upside move, right? Instead, you took an early entry over here and dealt with drawdown and closed. Then you saw this rejection and took another entry up here. When price dug lower but failed to break, you still hesitated and closed. So when you're thinking just based on impulsive and emotions, even though you may be looking at price to approach a major liquidity zone, you're still going to make stupid, irrational decisions because your brain is thinking, if I don't enter gold at this first half of this liquidity zone, I will never see this opportunity again. How do I know that? Because that's what my stupid ass brain used to tell me as well. Your brain will trick you just to fuel the dopamine aspect of it and to fuel the pleasure model of it because it just wants you to take that risk and potentially make some money right now. Your brain's never thinking long term. You have to train your brain to think in more of a long-term timeline, right? So people, they'll be looking to call a top on something on gold, and they'll say, oh, gold may reject here. And they're like, oh, if gold peaks into the 2000 price, I'm going to be looking for high risk, high reward sells. And it might not seem like much, but as soon as gold taps 2000, first tap, they take a sell there. Gold goes up another 80 pips, they get canceled out. Then they get a late entry, they don't get any entry, they try to chase, they get caught in a pullback. Where me, I'm like, okay, clearly we just had a high printed, we're still in bullish formation. I would see some high risk, high reward sells if we can't break there again. Me, I'm entering on this third double top here, or second rejection at the same highs. If I'm even going to take a counter trend trade, what I'd mainly be looking at after that high was printed was mainly how this pullback is going to retest previous highs and creating a beautiful double bottom and support. And then these pullbacks going to that same liquidity zone again before extending higher, right? So there's a few things to take away from this lesson here. What are those things? One, you can have a lot of success on gold and other trading pairs on an intraday perspective of just focusing on major liquidity zones that are very easy to identify. And more times than not, fundamental catalysts are going to line up with either revisiting these liquidity zones or rejecting off of these liquidity zones and having the moves take place, right? Number two lesson, don't listen to your brain that when you're first revisiting a liquidity zone, that on the initial 1 minute candle, that's still 20 pips away from entering into it, you're just getting eager to enter early because you think you're never going to have that opportunity again. That's not rational and it's not logical. What is rational, what is more common, what is logical is that when you're looking at the example of gold, gold can retest a liquidity zone for hours, if not days, before starting to have a nice move. And you can get fantastic intraday moves within this liquidity zone here. Then, even if you feel like you have FOMO, you missed this entire move, gold, if you don't have enough volume to break higher, a short-term fundamental catalyst going against sentiment can retest into those liquidity zones again, right? Let's look at some examples here. High printed, impulsive move, prints new intraday highs, right? We're in bullish structure here. We want to play the bulls. Beautiful breakout of the highs. It would ideally be good to look for retests of those highs, even if you came down to this liquidity zone again, where you clearly saw order flow accumulated before extending higher there, right? Now look, this first initial tap of these previous highs, yeah, beautiful, fantastic trade. From 1910, you bounce all the way up to 1925s almost, 150 pips. But guess what? The next daily candle retests into there again, gives another opportunity that extends even higher from 1910 to 1930s. Guess what? Still not enough volume to break those highs. Dig into that liquidity zone again, just shy of 50 pips. Then finally have enough volume and volatility to extend to the same range highs, which from an intraday perspective, all three of these are great day trades. This bounce, this bounce, this bounce, and extending higher are all fantastic day trades. But what's key to understand here is gold retested this area 3 times over the course of about 3 active trading days, right? And still maintain structure, still maintain trend. You didn't have to be playing guessing games of how the bears were initially falling, trying to enter here early or trying to enter up here again late. You don't have to do that if you understand how gold moves and waiting for these important liquidity zones, right? Impulsive move, print new highs. These are the previous highs. This is a very important play because you're going into a historical price point. Pretty equal correction and pullback phase here, but you go to retest these previous highs. important liquidity zone roughly into the 1930s there. First initial rejection and bounce. Rejection candle, failure to break below, bullish candle, nice intraday bounce. This is 1935 to 1945. That's 100 pips. Create a support into there again, still bounce. Reject into there lower again, still bounce. Fail to break again, then still have the extended move. Right? Gold can retest into these areas, starting to fake out traders, accumulate order flow, cause doubt against your bias, and still be extending trend or extending structure like it's nothing. Right? You can see that here at the same exact price sensitivity area, roughly into the 1975s. Look at how many fantastic day trade moves you had here. Look at how many retests of this liquidity zone you had. Look how long this timeline was of 2 weeks almost before finally extending up higher. Right? So now when we're looking at gold, it's not like we're expecting buyers to come into play back to the 2000s, but gold moves in very sporadic waves, whether it's bullish or whether it's bearish, right? Whether it's bullish with banking sector fear, you're still going to have these sporadic pullbacks, retests of liquidity zones. Whether it's bearish, you're still going to have these sporadic pullbacks. Why does that matter to us? Why does this movement and behavior of gold even matter to us? Because we're day traders. We're scalpers. Even though it's very easy to say gold is bullish during this period of time, you can't just mindlessly come to the chart at any hour of the day or any day and just start buying. You might get caught in one of these very aggressive pullback waves, where even in this bullish trend, you're still going to lose. You don't have the margin to be handling 200 pips of gold pullback. You don't have the capital for that. You don't have the risk management for that, the hedging capabilities for that, right? Very easy to say here, oh, gold correcting from the 2000s, very bearish, but you can't just pull up to any Tuesday or any random day and start selling. From a day trading or scalping perspective, these hundreds of pips in pullback waves can cause a lot of damage, right? So when we're looking at gold here, this is where we have to be very careful looking at this liquidity zone. We can even see that we might get very similar repetition here. What do I mean by that? Look at this. So it might be difficult to see, but obviously this was a bearish run from the 2000s down into here, right? This is that important liquidity zone roughly around the 1895s. This movement might as well be the same as this. This might as well be a wick for all I give a shit. It's a huge dig into this liquidity zone with an overall bearish move there that gets completely snapped back even higher up into the 1912s. We dig back lower into the 1900s before extending higher and having this formation. Now, don't just look at this. Look at this very carefully. Let's look at the price the bearish move comes down from. Let's look at the price the bullish move goes up from. Let's look at the price the pullback goes down to, and because the markets always repeat themselves, right? Boom, bearish move down price. Oh, will you look at that? From like the same prices here, right? Bullish move up price. Bearish move down prices from that same area again. And then this bounce that occurred from here is from the exact same price where we're seeing this reaction here, right? This is the exact same price formation so far as well. Even this prior, where you had this little bit of a wick first, then you dig lower, right? Boom, boom, down, up, same rejection area, same formation, same liquidity zone, right? So just understanding gold's behavior through backtesting it and developing this knowledge, we have to be very careful where it's very difficult to see any more gold sells unless we have more fundamental catalysts supporting the soft landing narrative, aka we need way more optimistic US and global data. If we don't have that optimistic US and global data, if we're not trading below the 1895s to 1893s, then give or take some pullbacks into this area, it does look like we're going to start to extend our way to the upside and can be easily digging back into the 1930s again for an extended pullback wave. Does that make sense to everybody? So even from a scalping session perspective, with the new 4-hour candle, when we're looking at gold here, we can see this daily's already made a little bit of a lower wick. We're coming to this previous wick rejection here and just a little bit below 1902 key level. If the new 4-hour candle fails to break below here, holds 1902, I'm going to be looking for these buy scalps back up and looking to scale in above 1905 as well on the lower time frame, chugging back up to the 1910s. From 1910s, I'm expecting it'll be a slow chug up into there, but then getting a break and retest up above there, starting to go up into the 1920s. Right. So the good thing is we got some China volume coming up in 10 more minutes here. And right now we're seeing that we've got weaker bearish candles here, rejections around the same wick price, potentially bullish candle closing back above 1902. I want to see a little bit of an order block or intraday support being created here over the next 4-hour period with making a lower wick and starting to look for these buys back above 1902 and back above this noise here at 1905 as well in the range. Very difficult for me to see any further sells. We don't have to just break below 97. We need to be breaking below like 1895s. Now, but anyways, I just wanted to give those quick scalp ideas because obviously China market volumes coming up. In terms of intraday trade ideas, I would still just be looking for failures to break here, buys above 1902, buys above 1905, buys above 1912. Only see any further gold sales below 1895. The reason why I'm giving these reminders is we've been playing pretty clean gold sales from 1980s down. It's very easy for your brain to get adjusted to a bias because you're so used to, for a period of weeks or days, sometimes even months, like we saw during the dollar domination phase of 2022, it's very easy to get your brain accustomed to pullback sells, break the low sells, sells, right? Very easy for your brain to get adjusted that way. But then that's just the trade ideas for gold. GJ, we just want to keep in mind the inflation data. Now, if CPI is lower than expected, which it can be, I see short-term bearish plays on an intraday perspective below 184.8 to be retesting back into this accumulation around 183.5, a data-induced liquidity grab before continuing more bullish here. Otherwise, even for scalps during our Asian session and intraday trades, would just be looking for these continuation buy plays. CPI data induced pullback, short-term, declining inflation, intraday bears below 184.8 correction, retest expect buyer bounce 183.5s. Otherwise, even for our scalping session today, We're going to be looking for some of the continuation buy scalps on GJ with 1 minute breakouts and break and retests from 185 and 185.2. Now, with a dollar, we're still holding bullish formation and structure, but focus is going to be on the industrial production report tomorrow. Right now, dollar strength is still maintaining weight, but we need to be breaking above the high to validate that. Otherwise, what's very common with dollar, whenever you have these new intraday highs printed, is you can see these aggressive pullback phases occur, which this pullback phase can be easily, don't mind the subjective trend line. Based on market structure, the pullback phase can be easily digging into a little bit higher than the 102s before still extending trend. So we really need to be breaking above 103.5 to be playing any more dollar strength bias. Otherwise, we have to be cautious where if we get any contractions in US economic data, signs of weakening with banking sector downgrades or more uncertainty with like the industrial production report that's in focus tomorrow, then we can see some signs of exhaustion and a dollar pullback phase take place, which can last for a period of sessions, if not days. So if we want to extend dollar buys, we need to be trading above 103.5. Otherwise, be cautious of exhaustion building in this area. In the example of Euro USD, this just means that it's going to be a slow grind for these sells back down to 1.085. We could easily still be getting retests with how we can get pullbacks on dollar index of retesting into 1.095, or we would just need breaks of these lows to continue lower. So bringing that information together for trade ideas, if we break back above 1.093 and 1.096 and show signs of dollar exhaustion, I do see another short-term pullback phase to that liquidity zone before continuing more bearish, which is very common on the dollar pairs. Otherwise, new daily just making an upper wick and breaking this intraday zone, as well as the following key level with dollar trading higher than 103.35 there, just the continuation sells we've been playing. GBP USD is a similar idea, but with potential of declining inflation coupled on the UK side anyways, coupled with dollar still maintaining strength. I'd still just be looking for these main sells. A pullback would be very short-lived to 2.8 and still looking for continuation sells there. USD CAD is more on the bullish bias, looking for these two pullback areas. And of course, we're just sitting at the previous highs now, where we had this little bit of an order flow accumulation that still hasn't been invalidated just yet. So trading above here, just extending buys would still be a very good trade idea from an intraday perspective, playing dollar strength. UJ still looking bullish here, yen relatively flat, no major fear, uncertainty, or doubt. We just have to be cautious about excessive volatility if yen weakens at a very aggressive rate and UJ specifically starts having very aggressive upside moves. But other than that, I don't see us having some major pullbacks until we're still digging into like the 147.5s, 148s. I just would prefer to see a slow chug up into there. And you may be wondering, gee, why the fuck would you want to see a slow move up into there? Normally, everybody wants high volume and volatility. It's because if this goes up too fast, Japan government's going to jump in and do some currency interventions, causing very aggressive downside moves like this. Right? And the currency interventions, they're not on a schedule. They're not like, hey guys, next Wednesday, everybody be ready. We're going to do a currency intervention. It's stealth. They call them stealth interventions. They can happen at any time of the day. Sometimes these mans are waking up 3 a.m. their time to do a currency intervention, to be impacting North American market hours. You know what I mean? So that's why I would love to still continue to see the UJ buys up into here, but I don't want to see a straight shot into there because it's almost going to guarantee another currency intervention. If we still see some minor pullback wave with bad data, slowly chugging our way into there over the course of the next weeks and months, then it's controlled. It's not really bringing any major concerns for the Japanese government to perform currency intervention. US 30, we had a bearish close below that 35K price point, confirming way more signs of exhaustion from these highs we've been identifying and that next major liquidity zone around 35,600. But remember, corrective markets on equities can be very choppy. If we don't have consistent declines in global economic data or any other catalyst to bring some sour taste to the greedy mouths of stock market buyers, then we could still have very aggressive waves as we're correcting our way back down. I don't really prefer that. What would be preferred now is just starting to get some continued worse data, geopolitical tensions bubbling, more downgrades by these major credit companies on US banks and the US financial system, and a 50% correction of this bearish candle, like a pullback into that 35K, 35,100 price, and starting to give some pretty clean corrections where we may not see any clean buy bounces until 34,400s or 33,800s. So I still want to play this correction now that we're trading below that price point. We might just dig a little bit higher into there before starting to sweep and have a deeper corrective leg, right? You can even see with the example of this secondary phase of market structure with this pullback phase or this accumulation phase, very aggressive waves, right? It's like a spoiled child. When they get their way, they're going to be all nice and kind and very smooth, steady, agreeing with you. But when you got to tell them to do some shit that they don't want to do, they're going to make it a mess, right? That's like with the stock market. When the stock market's pushing bullish, corporations are happy, industries are happy, the 1%ers are super happy. They're going to have some clean movement to the upside. But when you have inevitable responsibilities, aka fundamental catalysts that will sour that sentiment and lead to bears in the stock market, it's like a stubborn child correcting price here, right? So pretty similar idea we may see take place with this correction down to 34,400s. It would be a blessing if it was a straight shot correction like that and impulsive bearish moves. Overall, I would still be looking for around this area here, maintaining below here, where one, we're showing the exhaustion from those highs, two, candle body closed breaks below here, three, we saw clear more accumulation of sell order flow, would be a 50% correction of that daily candle that closed bearish. So pullbacks into here, or just breaking these current lows, correction sells. But that's just more of a bit of a fundamental refresher, educational reminders, market analysis, and trade ideas. Now for the Asian scalping session over the next hour, as we have China market volume right now, we're going to primarily just be looking at gold and looking at GJ. Now with GJ right now, it's a similar type of trade idea where if we show more signs of exhaustion, we can start to get the pullback phase below 184.8, which I think will also be extended if CPI is lower than expected, starting to drive us into 183.5 before starting to see buys. Scalping perspective, we just want to be taking advantage of the PPL to PPL correction. Otherwise, if we don't have the confirms of breaking below 184.8, we're going to be jumping in the buys above 185 and 185.2. On the lower time frame, we're just starting to create a little bit of a larger order block and consolidation phase here, which I don't really want to be trapped in the middle of. If we want to take the buys, we'll get clean-cut confirms of exhaustion by also trading above 184.95. So we can get entries 5 pips earlier than the PPL, which does matter when you're scalping, entries up here for the buys or above 185.2. With gold here, let's jump into the 1 minute time frame. Now, we're not showing any major volume or volatility, but that's okay. We can see as we started to get buyers coming into the market on the lower time frame, we had the rejection obviously at 97, this lower time frame break and retest here, a retest into there at NYSE before extending up into the 1912s. If the new 4-hour candle fails to trade below there and holds back above 1902 and 1902.5, we're going to be taking buy scalps 20 to 25 pips back up into the 1905s area here. I can only see any further gold sells with breaks below 1897s. So this new 4-hour candle is just opening up. What would be ideal is not even just retesting into here, just creating an accumulation and starting to get the breakout back above 1902, validation to hold above 1902.5, starting to get reactions at these lower time frame price sensitivity areas as we don't have much volume and volatility through Asian sessions so far. This is an important area of interest for us. The order block highs, this lower time frame reaction point. Something that can play out into late Asian, pre-London hours as well. A key make or break area we're observing there, of course. Oh, shut into your question. Since we're tapping into a higher time frame liquidity zones, yeah, that's what we've been talking about, man. Sometimes I'll get caught taking a trade with trend. So what do you mean? Like you'll get taking a trade with a sell still in the bearish trend, but then take a loss as it's shifting to a bullish trend? Is that what you mean? For me, let's just say, for example, we've been playing the gold sells from like the 1980s down into the 1900s here, right? For me, that's had fundamental catalyst support it. It was very clear about the 1980s rejection, and then it's starting to look at more major higher time frame zones we can revisit. So now, even though I've been playing the sells from 1980s to 1960s, 1960s to 1940s, 1940s to 1900s, right? Because I'm already able to identify this important liquidity zone where we might anticipate a shift in structure, I personally don't even take any more sells. I'm starting to go with the bias of what I'm anticipating for. Hence, even though gold had a bearish move with structure down into the 1900s again, I didn't take those sells. I took the buys that I've been anticipating. So it really comes down to you just sticking to what your original trading plan and pre-planned analysis is. For example, you didn't just see me randomly start telling everybody, hey guys, I'm looking for gold buys in the 1900s this morning, right? You saw me giving you guys updates over like the last week now. Even as we were getting that last sell squeeze, you guys remember me saying in the webinars, hey guys, we're still playing these sells. Sells still look good from 1920s into the 1905s here, but start to be very cautious as we're digging into this major liquidity zone into the 1900s. If we start to get mixed or bad data, any changes to sentiment, we can start to get very aggressive bounce waves from here. Hence, I was able to anticipate and jump in a buy and take advantage of a day trade buy from the 1897 and 1902 key level. But thanks to experience and thanks to understanding how gold behaves, I didn't hold the 1902 buy and I closed partial on 1897 because what I was showing you guys earlier of gold can retest into these liquidity zones multiple times before still continuing overall trend. Right? So the main thing is, if you're doing your analysis and you're identifying a potential shift in structure, start to look and anticipate to play that shift in structure. Don't confuse your bias and say, all right, I'm going to still look for a couple more sells down into here, and then we'll see if we get the shift in structure. That's how you get trapped in what you're saying. Where you might be in a sell, you're going to look to hold the sell further, but then we get the shift in structure in an area we already anticipated it anyways. Right? So a great example of this is the whole purpose of how I've been prepping you guys about the potential buys that can come from the 1900s, right? It's not just from a technical standpoint. You have to also understand when you have these clean trends on asset classes like gold or GJ, where you may be playing a bearish bias from an intraday perspective, or even primarily when you're scalping, playing a bearish bias for a period of days, weeks, if not months, it's very easy to get psychologically adapted to that bias. So a few ways I have to help that is one of the reasons why I'm always still zooming out. You'll see me always clear my chart and delete all drawings, even with all the key levels and everything. Simply go to the daily or 4-hour chart and zoom out, because it's very easy to get lost in a bias you've been playing day in and day out. And then you get caught in a major liquidity zone, gold starts to have a pullback, and you're still looking to try to sell it as it's doing hundreds of pips in a bullish pullback. Does that make sense to everybody? So it's why we always do fresh analysis daily. It's why we zoom out, identify these liquidity zones. It's why we warn ourselves saying, hey, everybody, we've all been playing mainly these gold sells from 1980s to 1900s, but digging into the 1900s here, we have to be very cautious. We can't see any more sells unless we're trading well below. Otherwise, we might see some very aggressive bullish pullback phases, and it's going to be data dependent now, you know? So that's with gold here at the 1900s. You can already see we've had a couple of bounces from this area, and we're still holding above it so far. So we still have to remain very sharp and adaptive to the current conditions. But I'm just going to go to the washroom here quickly and fill up my water bottle. If anybody has any questions, charts, complaints, issues, trade ideas, maybe you want to look at a different pair. Well, what times? Let's go check out. Let's look for some. If NZD just does the rates, keeping rates unchanged, NZD JPY or NZD USD, NZD JPY might have a short-term downside spike before still continuing some of its bulls. So here quickly, GBPJPY, just because it'd be fun with the interest rate decision. What time is it at again? 10? If it's at 11, that's going to be too late. NZD-JPY obviously has been more higher time frame bullish, but we could easily be breaking below this area with a priced in expected holding of rates and see spikes down all the way into 82.5s, 85, before starting to see bulls come back into the market on the macro rate differential still. So I'd be looking for some NZD JPY sells below 86.3 and 86.2 for buy bounces at 85.5 with the interest rate decision. Otherwise, if they bring a more hawkish tone, we could jump in some buys above 86.8 for an NZD JPY scalp, playing the interest rate decision. What time is that at? Ten PM. That's not too bad. That's 45 minutes from now. So someone give a reminder 40 minutes from now. We'll look at NZD JPY for fun with the rate decision. If rates are unchanged, copy and paste statement. Can see a priced in sell side move to set up better buys. Short term from 86.2 down to like 85.5 before bouncing. Or we'll jump in buys above 86.8 on the 1 minute time frame. All right, just gonna grab some water and stuff. So let's see if we fail to break this 1900s area, even if we dig a little bit lower and snap back above. And I'd be looking for the buy scalps coming back above 1902 for gold here. And only see sales really breaking below the 1895s, that liquidity zone of interest. So we'll be waiting for these scalp style setups, which I'd probably do something like this. I'd want to see. Otherwise, difficult to see sells unless we're still holding above that liquidity zone. I messed up the drawing. Okay, you guys saw what it looked like. All right, if anybody has any charts, questions, send them in the chat. I'm just gonna grab some water super quick. All right. Now, another reminder I wanted to give from a fundamental standpoint, and something that we have to start to look out for, is I was talking about it on the yen, right? Where I was talking about Japan government currency interventions as the yen heavily gets devalued against the US dollar. You have that macro rate differential, of course, right? Now that same thing is taking place with China. China's going through a lot of economic negativity right now, seeing declines across the board with their credit market, banking sector, real estate, property development market. Their stock markets are feeling the heat and so forth. So obviously, to provide support for their economy, they've been doing rate cuts and flooding their markets with liquidity. Now, they're doing this to support the economy, but the result of this is the Chinese yuan getting devalued. You can even see the headlines, for example, when China markets open up, where you see China's offshore yuan declines to a 9-month low as per the dollar. It's always everything against the dollar, right? So one thing you also have to look out for is China does these currency interventions, which can be Chinese state-owned banks buying yuan against the dollar, or the government doing currency intervention in a very similar style to the way the Japanese government did it. Now, overall, this would actually support and bring more demand into gold and bulls on gold, but it would bring some fear and strength to the yen, as obviously doing currency interventions is abnormal and it's fear inducing, bringing risks to the global economy, because you're only supposed to be doing currency interventions in very unique situations in time periods, right? And it's like putting a band-aid on a machete wound, right? For example, when the Japanese government is doing currency interventions, they're doing it to counteract how aggressively the Japanese yen is devaluing. But the main reason it's devaluing is obviously investors are going to short the yen when the Japanese government and Bank of Japan is just sticking to negative interest rates and pumping up the markets and pumping up their economy. Obviously, it's going to make shorting the yen a very appealing position. Now, they already understand that the yen is going to get weaker, that it's going to devalue, and it's a part of their long-term plan. And it's like an expense for the central bank to play as they're propping up and stimulating the markets and economy, right? But what they do not want is excessive volatility of the yen devaluing, because that has major negative implications to the Japanese economy. So whenever the yen is devaluing at a rapid rate, they do these currency interventions to slow down the rate of where the yen is devaluing. And it's like putting a band-aid on a machete wound. We have a very high probability of starting to see those types of plays by China as well over the next days and weeks, as they just did more surprise rate cuts yesterday. And we were talking about that, of course, within the trade room there, right? And breaking that down. And China, you have to understand, does its best to conceal all of their like any downtime that they have, like any negativity that they face, whether it's from a social, political perspective or economic perspective. They're very good at concealing it and keeping it within closed doors, because they want to look like this super perfect powerhouse on the global image. They want to just look like the richest, largest, most powerful country that doesn't have the same problems these Western countries have, right? And America always combats and fights to do the opposite of that and look like they're the best country and they don't have the problems China has. But China's a lot better at keeping their shit under wraps compared to America, where everything's in the media in America and spreads around the world and so fast, right? But what I want to tie into here is China can't really hide if they continue to see economic weakness, because the beauty of it is these global markets are very heavily interconnected. And if China continues to face a lot of economic turmoil, a lot of economic downside, it's not just going to be impacting the Chinese economy. It's going to be having it spill over to Asia Pac section, to the US, and so forth. Does that make sense to everyone? So we have to keep an eye on this, because if China continues to face this turmoil and downside, it's going to be having a ripple and domino effect on global economies, like 100% chance, you know? 9:30, new 30-minute candles. Nothing really going on here on GJ. Gold, nice little follow of our line so far. Nice little rejection from the 1900s for the high risk, high reward mans. For the regular people, we would just be looking for the entries from 1902s. Keep in mind it's Asian session, so it's less volume and volatility, but I'm expecting reactions around these areas still, and not expecting a smooth shot to the upside. If we do get a smooth shot to the upside, that's just outside of our expectations. It's like getting a bonus in a video game, or like a cherry on top of your sundae. It makes our job a lot easier. It makes it a lot more enjoyable, but it shouldn't be what we initially expect. You know what I mean? It's like getting a bonus at work. You should be expecting to get your normal pay. If you get anything above that, it's extra, you know? Equities are pretty soft through the Asian session hours here. Still looking pretty slumped over across the board, which is good. The reason why I say it's good is just for overall sentiment, that we can see sentiment starting to shift, a lot of that greed getting faded out, even in Japanese markets where there's so much stimulus active and conditions to support more upside in equities. We're still seeing a pretty equal correction around the globe taking place here, with softness on the stock markets. So we could start to see safe haven strengthen a little bit more there, you know? Great analogy. Which one? I don't remember now what I said for the analogy. Oh, the bonus thing? Yeah. Yeah, for sure. How much water do I drink? I'm not sure. Like a gallon, or I actually don't know what a gallon is really. This big ass Yeti. This big Yeti bottle. It's pretty big, pretty hefty. I try to drink that at least one of those a day. But water's pretty bland for me, so I throw in this little sweetener, this sugar-free sweetener in there once in a while to change it up. Add some pop, add some life to it. So keep in mind with gold, we saw the 4-hour candle make a lower wick, right? Retest that area of interest we identified roughly into the 1900s there. Failed to break with buyers coming back into the market. Stronger bullish sequence of events, with this basically being a mini break and retest above 1902 here. For Asian session, pretty good volume of a 15 pip squeeze so far. Now, because you have lower volume and volatility, there's increased probability of getting reactions at lower time frame price sensitivity areas. What do I mean by that? Well, when you have higher volume and volatility, whether it's just due to fundamental catalysts in play, continuations of sentiment, economic data, and so forth, you don't really get as many reactions at lower time frame price sensitivity points. You usually melt through those points, through those price points like butter, like a hot knife through butter, and you go to revisit more important intraday or higher time frame liquidity zones. But when you have less volume and volatility, you're seeing way more transactional order flow taking place on the lower time frame. So you get way more reactions at lower time frame price sensitivity areas. That's why I anticipated we could still be seeing reactions around 1903. Now, the overall bullish impulsive move is coming from above the 1900s to here. We're just calling the buys from above 1902s. Now, to maintain a bullish sequence of events, getting reactions at these areas is perfectly fine and understandable. It's just order flow and less volume and volatility, as you're going to be moving in waves, right? Think about it when you have less volume and volatility on the intraday timeframes. That's when you see these larger consolidations get created or larger pullback waves that move like this. Versus when you have impulsive moves with data, you have a straight 100 pip bullish candle to the upside on bad data. It's the same thing on lower time frame. You're just adjusting to this time sensitivity and the smaller candles and price movement taking place, right? Now, with lower volume and volatility, we could easily still be maintaining bullish sequence of events by still retesting into 1902 and failing to break lower, doing a 50% correction of this bullish move and maintaining above the key level and that price sensitivity area here on the lower time frame. Or what's obviously going to be a more clear indicator of more buyers in the market is just a short-lived pullback and trading above 19035. Then you can make the decision to hold trades further, or even with this pullback as you're retesting into here, when you break down this information, this is how you can create better decisions. Now, you could have already made the decision from what 1902 to here. Jeeve expected a pullback. It's Asian session. I'm just going to take that 15 pips and I'm going to close that trade and wait for another entry. That's a good decision to make. But if you want to hold the trade a little longer, which is perfectly understandable and can 100% take place over the next minutes or hours as you're trading into Asian session, you might say, well, I took my entries at 1902. I don't want to take profit here. I want to get more pips. Now, to maintain and hold this entry, I got to make sure price stays above 1902. This gives me very easy decisions to make. One, thinking about risk management first, if we get bearish breaks below 1902, canceling out majority of this price action, closing back below this price sensitivity area, I'm going to have to trade manage and secure at a minor loss of 5 to 10 pips or whatever it may be. That's a decision I have to make. But if we just retest this area, fail to break and start bouncing, and we show signs of rejection, I'm still going to hold. Or if we break back above 19035, I'm obviously still going to hold. This is the mindset and how you have to be thinking when you're scalping, because every minute of price movement matters for a scalping style trader, right? This is why so many people used to love when I was doing the scalping sessions before people would bother me and not put effort in, and we had a smaller community. They loved when I'd be giving the minute-by-minute candle breakdowns, which would just basically be like this. Me drawing ahead of time, I can start to see signs of exhaustion here, bounce above 1902, pullback wave. This is where I can see reactions, guys. This is the volume and volatility conditions I see. These are the trade ideas. This is what price is showing me so far. Hey, mind this little bit of exhaustion, but as long as we're still holding above here, it's bullish. Trading above here, it's bullish. Right? People like that because it breaks down price. It walks them through everything with me holding your hand, and you get a lot more confidence because I'm telling you what to look for. I'm telling you, hey, if we hold above here, your trade's still good. If we break above here, even better, right? If we break below, trade manage. And you even, most people, they loved it when they even just took a minor loss because they closed when I told them to close. And they usually be like, oh man, gee, if you didn't tell me that, I would have held the trade all the way back down to here and took a 30 pip loss. This time I only took a 3 pip loss or a 5 pip loss in my scalp. Then we came back above the entry area and I got another better entry and that ran 40 pips. You know what I mean? But now it is obviously lower volume and volatility. We could still be chugging our way to the upside. Just in terms of maintaining lower time frame sequence of events, we'd want to be holding above this 1902 price point or breaking back above 1903.5 for any further entries or extensions of trades. Otherwise, we had that high risk rejection from this low area and just the squeeze above 1902 so far with Asian session volume. What I do like on the intraday time frames is the 30-minute candle still closing bullish above. This new 30-minute could still just be making a lower wick here. And I do want to see how this hourly candle closes. I would love to see the hourly candle closing bullish above here, which gives even more confidence to be holding some of those positions further. Pretty solid bullish sequence of events here so far as well. This is still looking like a pullback, but this is the steps there so far. And another like 20 minutes, we'll check out NZD pairs. We'll see if we can get any fun with RBNZ rate decision. So class, now we can see after having this minor pullback phase to retest these previous highs and getting these rejections, we didn't fade out the upside price action and we did not close back below 1902. This means from a scalping style perspective, understanding the sequence of events, we still had all the variables to be holding the scalp trade from 1902. Keep in mind, digging into some next areas of interest, 1904s and 1905s. Now, the one thing we also have to look out for is the increase of volatility with the new hourly candle, just with Reserve Bank of New Zealand's rate decision. Obviously, it's during Asian session hours, so it can bring that volume and volatility. But even though we might get these aggressive little snapbacks, we still want to keep an eye on overall key price points of interest here. This was a more minor one digging into, where gold is still bullish, even if the new 15-minute candle and hourly candle comes into 1902, and especially if we still maintain above 1903 and this current new 1-minute high being printed. The good thing is we're still seeing these 1-minute highs being printed and these very minor accumulation phases of picking up some more liquidity on the lower time frame there before extending this bullish sequence of events. Even if we get a more aggressive liquidity grab, it's still bullish holding above 1902 and this overall double bottom leg formation there. But the one thing you have to note is just market timing, the new hourly candle close, and the New Zealand rate decision. GJ still just ranging between PPLs here. No correction styles below 0.800. Might not see that till UK inflation data. Equities are still pretty soft through the session as well. Now, if gold breaks below this price point before the hourly candle close, then we can easily see deeper pullbacks with NZD rate decision volume. So you just have to keep that in mind, because obviously we do have some events in play through the Asian session, which is that rate decision. If we want to be holding these trades into the new hourly candle, I want to at least be closing 15, 20 pips above my entry, just in case then I can still manage any aggressive pullbacks or potentially just hold break even to prevent loss and get a better entry after. And then that way, if you're floating 15, 20 pips, if volatility just goes in your favor, you're just safe and easily in the money there. But in case it doesn't go in your favor and you get a pullback, you're not having slippage or your order completely slapped out. You're just having a pullback to your entry first, which you can control. You know what I mean? So we still got 8 more minute candles, but right now it's still looking pretty juicy. Just want to be extending to these highs and so forth. Still maintaining these bullish sequence of events. And we're still showing some nice bullish price action for those scalps we were talking about. Yeah, it's Asian. So if you get 20, 25 pips, whatever, you know what I mean? Pretty nice scalps. Can't go wrong. Could have had a pretty tight stop loss in this area as well. For the scalping style and the range, didn't really need to be putting it below these lows. Dollar pairs are flat, which is expected through Asian if you don't have any major fundamental catalysts in play. UJ's ranging like GJ is. Equities are relatively flat as well. 0.5. I would work on getting better entries. We already had our pre-planned analysis. I even drew out, if you rewatch this, exactly what I was expecting price to do. If you're not comfortable with taking high risk entries, which is perfectly understandable and comes with experience, as soon as you started seeing this rejection and this price formation occurring at 1902, man, I'm just entering on anticipation there. You get what I'm saying? Because it's already what we're looking for. What you're looking for is painting out in front of your eyes. And no matter what, regardless our job as a trader, if you enter in the market, it's going to be risk. I'd much rather enter some risk that's following the painting I already had pre-planned. You know what I mean? So a little bit late there, 0.5. I should have been entering in this area for sure. Keep in mind, new hourly candle coming up shortly. Let's check out, let's fuck GJ over here, pardon my language. Let's check out, obviously GJ same trade idea stand. Like if we break above 185, I'd see some nice buy scalps. But let's check out NZD/JPY because we have that rate decision about to come out. So right now, we're still bouncing NZD/JPY in this general intraday range. We have the rate decision in 5 more minutes. If they keep rates unchanged, don't bring any new hawkish events to the table, then it's going to be more bullish for NZD equities. And we could have some short-term bears and corrections below these lows after a pullback to retesting better buy zones. Otherwise, I would take some NZD JPY buy scalps above 86.8. But keep in mind, even on gold, we're going to see increased volatility. Like, see what I mean? Pretty aggressive 1 minute bearish candle, but that's only because we have a rate decision coming up. It's going to be impacting asset classes just through that Asian session period. So I still would love to see an hourly candle close bullish. And then the next hourly, even if it makes a lower wick into this area, still having some bullish bounces above 1902s, 1903s here. But obviously, we're just getting that increase in volatility right now in anticipation for the Reserve Bank of New Zealand rate decision. But we're going to put it on the 1 minute time frame on NZD/JPY. And then we'll see the headlines in the newsroom as well. We'll check the actual rate change right here quickly. There we go. The priced in sentiment is if they just keep rates unchanged. That's like bringing nothing new to the table. No further hawkish forward guidance, no surprise rate hike. If they do a surprise rate hike by 25 basis points and raise this to 5.75, then we'll look for NZD JPY scalp buys above 86.8. I always advise everybody should be only focusing on trading one pair, but this is for educational purposes on scalping a fundamental catalyst that you can apply to other trading pairs that you specifically focus on. Shit, where'd it go? We used to do a lot of Australian data and NZD data news trades through Asian session before the pandemic. Retail sales and stuff like that used to have like 100+ pip moves on AUD pairs. Huge liquidity grabs and stuff too. It was fun times. But that was when we had a smaller community. Everybody was more involved going through the educational webinar process. Everybody was on the same page, so I didn't have to explain basic mundane shit 10 times over, you know what I mean? But most people don't want to go through the educational webinar process and be on the same page and be on the same level of understanding. They just want to have everything handed to them and just be having their hand held through the market, which isn't going to really help you long term, you know what I mean, on your own. It's like always riding a bike with training wheels. Yeah, you're riding the bike, but you look like a fucking dork and you don't know how to actually ride a bike. You know what I mean? But in Capital Hungry, when you go through the educational webinar process and you develop your foundational knowledge, you're no longer just a dork member of a community trying to get your hand held, like all these other generic groups. Now you're actually a valuable member of the community who's on the same page of understanding, knowing what's going on in the markets fundamentally and technically, and taking advantage, you know? Okay, rates unchanged right now. Right now, 1 minute PPL to PPL spike to the upside, which is pretty funny because the yen PPL marker was already on GJ, and it looks like it's pretty nice on NZD JPY 1 minute time frame too here, right? But anyways, this could just be a liquidity grab. It's the expected priced in sentiment. If we see the next couple of 1 minute candles follow like this, I'm going to be taking shorts below 86.5 and 86.4 for short-term bearish corrections. Only safe buys would really be above 86.8, and that might even be short-lived to the range highs and still getting faded out. They're not really they didn't do any rate hikes. They didn't give any forward guidance to rate hikes, keeping everything in 2024 at this 5.5%. They didn't really bring anything new to the table in terms of information, which is flooding the newsroom. You guys can go read right there. So to me, this looks like a liquidity grab. Next couple of minute candles fade out, cancel out this move, break below the PPL 0.5, fade out this low, start seeing a correction take place. Only short-term buys above 86.8, which would be faded out at 87.2 in my opinion. So we just had that initial volatility prior to the decision right there, but because they didn't bring anything new to the table, not seeing any excessive volatility on gold, which is a good thing, you know what I mean? Not getting a random 50 pip wick down for no reason whatsoever. just because Reserve Bank of New Zealand wants to shock the markets a little bit. But they didn't shock the markets. They're taking a slow and steady approach, similar to the other central banks, following suit with the Fed and going based on data dependency. Just they've already done the heavy lifting of aggressively raising interest rates over the 2022 period, and they're already in a restrictive stance. Like they're already in restrictive stance territory, being at 5.5%. So gold trade idea is still the same here. Even if we get retests of 1902, or we just chug our way back and hold above 1904s, still looking pretty bullish where this can be chugging away over the next couple of hours into pre-London timing. No major impact on equities or anything like that. The good thing is Reserve Bank of New Zealand just did what we expected of bringing nothing new to the table and keeping rates unchanged. So we just had this little spike before the data release, but no crazy volatility we're seeing because there's nothing new being brought to the table. So give or take some reactions here, can still be chugging our way to the upside up into the 1905s, into pre-London hours for sure. No, probably gonna wind this up soon. Don't want to make it too long. We're coming to like the 2 hour mark, which is pretty long because some people want to watch this as a market analysis webinar. But obviously on Vimeo, you can just fast forward to whatever parts you want and stuff like that. 2023 technology. But we'll be winding it up shortly. We'll see how this like next 15-minute candle closes, and I'll give you guys my final remarks on what we can see take place on gold. I would love to see this move still get faded out on NZD/JPY, but doesn't look like much volume or volatility there. GJ potentially giving us some corrections taking place, which could also be the markets just anticipating and pricing in lower inflation report with the breakdown I gave you guys at the start of this webinar. So would love to see us just digging into this order block, not correcting this downside move, and starting to chug down and getting some corrective plays there. We might dig a little bit into the PPLs here, just with how price is moving. No, if you guys got any questions or anything, feel free. There's not much more for me to discuss. I'm just watching. We're just observing price action now. We're still just holding those same 1902 gold buys as we're still maintaining that bullish sequence of events, of course. Now, the next thing is I want to see if after that pullback phase, an hourly candle made that lower wick, we can start clearing this high and extending up to 1905 targets while still maintaining this bullish sequence of events. Just looking at areas of interest where you can expect to see some type of reactions or waves in the lower time frame here. And then going through that process of asking yourself questions of what's giving me data to continue to hold my trade, or what is telling me I need to trade manage and get out of this position, secure some partials, set my stop loss at break even. So now this is the area of interest we have to watch. Had that solid bullish sequence of events here. Pretty decent correction. Still saw more buy side orders being accumulated here. Pretty decent bullish price action here as well if we can break out higher. Yeah, it'd be nice also with the next 5-minute candle to be trading above here and closing higher. Then just expecting some minor reactions as we chug away to the 1905s there. If this 15-minute candle doesn't close above this area and we're still getting more signs of exhaustion, with the less volume and volatility, then that's going to mean increased probability of getting deeper retests into the 1902s and accumulating order flow before pre-London hours before starting to extend up higher. Otherwise, in the lower time frame, just to validate current buyer volume in the market to be holding positions further, we'd want to see cleaner candle closures above this high to maintain that sequence of events. Otherwise, you can see around this price point now is where we're getting the first signs of some exhaustion here. Here we were just printing consecutive higher highs after this rejection. You can see the same thing here and here. Now we're starting to snap back below this general area. So it would be ideal, while we still maintain a bullish sequence of events, to see candle closures above here. That really shows more buyers in control and extending up to 1905 with the next lower time frame leg up there. If we don't do that in like the next few minutes, then there's an increased probability the next 15-minute or 30-minute candle from our perspective as retail traders looking technically will be making lower wicks, which is just more order flow accumulating from lower prices, meaning we can be retesting into like the 1902s before extending higher again. But for Asian session, volume hasn't been that bad in terms of at least giving some price action breakdowns. And we'll do the same thing during New York tomorrow. Everything else is pretty quiet there. So the reason why you create, like in the example of lower time frame scalping, these price points of interest where you could expect some reaction alongside certain market conditions, is because price doesn't move like the example you're going to see in a textbook or just in a straight, clean, linear path all the time. Everybody has these expectations where in the example of 1902, if you're taking the buys here, everybody just wants it to move like this, right? Or just straight bullish candles, minor pullback straight to your target. So when you have those types of expectations and you want price just to be pushing with higher volume in your favor with minimal reactions at lower time frame areas, when you get any types of these lower time frame reactions or price or points where you just have price accumulating order flow, this is what creates a lot of hesitation and people start closing trades early or panicking or changing positions or over trading and so forth. Creating these price points of interest that you can identify on the lower time frame from a scalping perspective or on the intraday time frames for like a day trading perspective, it helps keeps things in an objective point of view, right? It's not just about seeing straight breaks above here. Even with the drawing that I did ahead of time, you're going to see if you rewatch this that I was expecting this type of pathway and price before really starting to extend higher, potentially going into like London session close hours, right? The key thing is identifying and making sure who is control between buyers and sellers as you look at the reactions at these prices. With the example here, we can clearly identify more buyers are still in control in these lower time frames we're looking at if we extend above the 1904 price. Or we can clearly identify if we don't break these current areas in just range, we're still accumulating order flow for a breakout. Then on the flip side, you also get information where you can anticipate deeper pullbacks if you're clearly starting to trade below this 1903 area, right? Or of course, if we're just extending trend, then you want to maintain above there and just start to see reactions at your next area of interest as you're watching price move up in a wave formation. And these are expectations that are realistic when you have lower volume and volatility. When you have some fundamental catalysts in play, like a data report, you might not see price move like this. You might just get very quick reactions at these lower time frame zones. Everybody always prefers these situations, but those aren't going to be the most common situations when you're scalping or day trading. It's going to be having to exert a lot more patience and be a lot more objective as you're looking at these price points of interest. But anyways, everybody, we're approaching like the 2 hour mark here. I don't want to make it too long. It's going to take forever to save and upload. I'll see everybody in the morning for our New York scalping session, where alongside the foundational knowledge that's given in the educational webinars, you can apply this information as well, which is given in through a lot of the old London sessions, a lot of the Asian study sessions. This is why I want new members to focus on learning first, because then I don't have to keep repeating these same concepts every single New York scalping Zoom session. Everybody already knows what to look for when we're talking about entries, our pre-planned analysis, what it's going to take to hold a trade further, why they should trade manage. Obviously, I'll be giving those reminders, but I can't be holding hands like a baby every single session. We're not going to be able to actually take advantage of what's going on in the markets or be immersed in what's happening fundamentally or technically that way. We want to gain this foundational knowledge, learn these universal concepts, and then be able to apply it on a situation-based perspective, as the market always has varying market conditions. Some days we have high volume and volatility with economic data, and we're looking to take advantage of a certain prediction, and we know we have to be more aggressive, faster with our decisions, can potentially hold trades with one-sided data. Sometimes we have to be a lot more patient, controlled, understand trades may take a lot longer to play out when we have less volume and volatility. But you can't anticipate any of that. You can't break any of this down if you don't have that foundational knowledge first, right? But who was able to grab some of the gold buy scalps and understood why we were looking for those buy scalps and the price breakdowns and holding some of those trades? Yeah, not bad for Asian volume, but apply these same concepts, London, New York, same shit, different day. Okay, then we'll see what's good.